Morning all, welcome to the Flow Show. Middle of the week already, 25th of September, and we've got quite a bit to get through this morning. Starting off in China as always. They've kicked off their rate cutting cycle that was announced yesterday. They cut their 1 year MLF to 2% from 2.3%, so 30 pips off of that one. They also fixed a big chunk lower, down at 7.02 versus 7.05 yesterday. So this one strength still continuing. I have had a last little ad down at 7.01. So that's the last bit I'm doing, and now it will either go to me stop or we'll see a bit of a bounce. But I'm not got the greatest hopes for this trade. But if I'm going to lose, I'm going to lose on my terms. So it won't be a big deal if I do get stopped out. So I'm keeping an eye closely on this one. Further rate cuts to come, as we know, but now they're all out in the open. It may have limited impact on the one anyway. What we're still playing is this rate cuts are going to be good for the economy, and that theme that we've been speaking about for the last few days is now starting to spread among a few of the big news wires and banks and the like. So they're also seeing the same thing too. So you know where you heard it first, of course. A bit of data out of Japan overnight. We had this corporate services PPI coming in, missing expectations, but matching last month, which was revised down by a pip. So it's there or thereabouts. It's still holding up pretty well for the inflation picture over there in Japan. Australia saw their CPI coming down to 2.7%, which was the lowest in, I think, 3 years, as was declared by some folks. So that's going the RBA's way. Again, another reason why hikes is going to get pushed further down the table. And we could eventually see them move into a more dovish stance, talking about rate cuts. This Bank of Japan core measure came in unchanged, 1.8%. Nothing to worry about on that front. The Riksbank, they cut their interest rate by 25 pips as expected, and we could accuse them of being followers of fashion as well, because they now started throwing around 50 basis point cuts as well. The statement said that the policy may be cut at the 2 remaining meetings this year, and one of those meetings may even be a 50 basis point cut. So joining the crowd now in putting the option on the table. The governor said that 25 pips at each meeting, though, is the main scenario. So they're going to keep with the 25s. But they're not going to ever rule out a 50. The notes also said that they could see a faster pickup in rate cuts than they had previously forecast, so we could get a bit of a speedy one into next year as well. Over at the Bank of England, one of the MPC members, Green, she said some slack in the economy needs to open up in order to return inflation sustainably to target over the medium term. She says, I'm still concerned about the wage pass-through to inflation, which is what we've been mentioning here, particularly those public sector pay rises, bumper pay rises, and train drivers and the like, still going to be feeding through. She says, you're not too excited about the below forecast services CPI. So no victory laps coming there. NatWest, the CEO was out with a couple of positive comments, saying he saw good activity in UK mortgages in the past months, and says that the recent rate cut hasn't changed customer behaviour. So it's all potentially looking positive for the prior cut and maybe for future cuts too. ECB's Muller says that services inflation needs to slow further, and that it's too early to have a strong view on the October meeting. It'll be easier to decide on a cut in December, although an October cut isn't totally excluded. Talk about covering every base on that one. ECB's Nagel says the German economy is expected to slowly pick up some momentum again, whether we're all died of old age before we see that. Remains to be seen. ECB's not. ECB likely to continue to gradually reduce interest rates at least through the first half of 2025. Rates unlikely to return to extremely low levels, and we're likely to end up between the 2 and 3% range. Again, we've been stating that that's all well and good, but if inflation doesn't play ball and it continues dropping, goes through target, goes down to low 1%, so even lower than 1%, that neutral rate is going to be coming down as well, and they're going to be forced to chase lower inflation with more rate cuts than they expect. This is going to be a fine line. This is making me laugh. Spain, they seem to be rubbing Germany's nose in it. Last week, after the shocking PMIs in Europe, particularly Germany, they came out and raised their 2024 growth forecast. Spain came out, their economy minister came out and raised 2024 growth forecast. And then after the poor IFO yesterday in Germany, Spain came out again and raised their 2025 and 2026 growth forecasts up a couple of pips each. So taking the opportunity, as I say, to give a little wave to Germany, how the southern states are now potentially outperforming the northern states, or the northern state of Germany. Yesterday's data from the US, we had the Philly Fed non-manufacturing index, which as usual is not on anyone's calendar. That improved to -6.1 from a prior -25.1. However, new orders fell from -0.3 to -17.8, so it's not all going swimmingly. Full-time employment rose from -15 to 0, so a bit of a jump there, but coming in flat on balance. Prices paid dipped to 19.5 versus 30 previously. Prices received fell to 6.2 versus 9.8, a bit of easing in inflation pressures there. Wages, though, that increased, the wages and benefit index, up to 34.6 from 30.1. We also got house price data from the FHFA and from the Case-Shiller, S&P Case-Shiller numbers. All looking a little bit on the soft side, flat on the 20 city number there for the Case-Shiller, 0.1 on the FHFA number. Year-on-year numbers coming down a bit too. The 20 city there, 5.9 versus 6.5 prior. The FHFA 4.5 versus 5.3 prior, and also the national, the S&P Case-Shiller national HPI coming down to 5.92 from 6.47. Now this is July data, so it is coming while rates were obviously still much higher and a bit of pressure on mortgage rates and things like that, but we may see this turnaround if the housing market catches the same positivity as everywhere else in terms of the 50 basis point Fed cut. So, as I say, this data is lagging behind by a month or two, so we need to keep an eye on it later on. Then we got the US consumer confidence, and a bit of a torpedo for all those bullish hopes after the Fed cut. That came in at 98.7. Was expected to fall back a bit, but not as much as it did do. So it really was a bit of a, as I say, bit of a kick up the arse. Current conditions fell over 10 pips to 124.3. Expectations dropped to 81.7 from 82.5 previously. And then another surprise, one-year CPI expectations rose to 5.2% from 4.9%. So not good news for the Fed, and they're easing bias now. They're seeing softer consumer confidence and higher inflation expectations. So that puts them, as usual, between a rock and a hard place. They don't want inflationary pressures coming back, especially as consumer confidence and potentially activity starts dipping. That's the worst of both worlds for that one. Of course, all that data got the market running around with its rate expectations, and a 50 basis point cut in November for the Fed. It jumped to 50% in certain metrics. The CME Fed Watch is still sitting that way, 58.2% chance of a 50 pip cut coming in November. So we're back playing that old game again, as was expected. The knock-on effect is evident as well, because yesterday traders also raised their ECB bets and see a 60% chance of a 25 pip cut in October versus a 40% chance. The wider thinking was that the ECB would only do policy moves at their quarterly forecast meetings, as they have been doing, but now the market getting a little bit twitchy over October and another cut from the ECB. The banks are leading of the charge for that. Obviously, HSBC has changed its call for the ECB, now sees a cut at every meeting starting October. I think previously, and I could be wrong, I think they were looking for a November or December cut and then a cut starting next year, but now they've pulled that forward. Bit of data also from Mexico, where we got CPI numbers as well. Where are those? That's there, but it doesn't show you the bi-weekly numbers, or does it? Yes, it does. Core CPI coming in there or thereabouts, 0.21%. What it doesn't show there is the year-on-year number, which just edged back a bit to 3.95% from 4.01. Headline CPI year-on-year dipped back a touch to 4.66 from 4.83 previously too. BOC's Macklem was out saying with continued progress we've seen on inflation, it is reasonable to expect further cuts in the policy rate. The rest of it was pretty much a repeat of his recent waffle since the BOC meeting. He did add that they want to see growth trending up over 2%. Political news. US Speaker Mike Johnson is promising that the House will not approve a single massive bill to fund the entire government in December. What's likely is that this small stopgap bill is expected to clear the House this week, which will then kick the can to the 20th of December, and they'll have to do it all over again just before Christmas. So we'll see how that fares, but it doesn't look like we're getting a longer can kick at the moment, just a short one. Trump following up on warning John Deere that he will slap them hard with tariffs if they move to Mexico. He's now said that he will put 100% tariff on every single car coming across the Mexican border. He then said that US-based manufacturers will be rewarded with research and development tax credits and the ability to write off the cost of heavy machinery in the first year. He will also set up special federal zones for manufacturers in the US. So I'm really only pointing this out because it is, amid all the mudslinging and arguing going on between him and Harris, this is some element of policy that he's going to be looking to put forward, which is pretty much in line with what he was trying to do when he first took office. Harris is expected to detail more of her economic plans in the days ahead, so we'll keep an eye out for those as well. Need to keep an eye on oil, gas markets, because there's another storm developing, strengthening as we speak. Storm Helene over the Gulf of Mexico. 16% of oil production in the Gulf of Mexico has been shut down, as has 11% of natural gas production as well. So still in storm season there, and that's going to be an influence on oil and commodity prices too. Right, that's it on the headline front. So let's start having a butchers around what's going on in markets. Just before I do that, don't forget our sale that's on the ForexAnalytix platform. Last few days to lock in a great price, and we've got big things coming over the months ahead. So if you're sitting on the fence regarding coming and joining us, then now's the time to do so. You can take advantage of any one of these deals going on at the moment. If you don't want to commit for the long term, then try it for a month and get 1 month free, and or you can do us for 6 months or even a year. So give it a go. You don't know what you're missing out on. Right, what's going on? Well, probably the biggest news so far is that euro dollar has had another move up on the big 112. Now, I've been pointing this level out for a good long time now. So we've had another test. 111.99 is the figure we got to on this move. If we get a break here, we do have that 61.8 fib above 112.75, but it could be that if we break there, I don't know if that's going to stand in the way or not. We could then be on for a move to 115, which, as I'm always pointing out, is an absolute stonker of a level. It goes back and back and back and back and back, even before the euro even existed. That's how good a level it is. But jokes aside, it is a doozy of a level, and unless there's really something untoward happening, if I see it up there, I'm definitely going to be trying that one for at least a big figure play, if not for something more long term. But early days yet, but we need to plan. So what has happened is we have had a test up there. The dips at the moment are pretty limited. I'm just going to chuck a little line in there, because this is where we're dipping down to, this 75.80 area. So that is really the near-term support that we need to keep an eye on. If we're under there, we may have some minor levels down around 65, 67, 70. Otherwise, it's down at my old 11.50, 45.15, 11.30 area down there as well. So the fact we're not pulling back too far from this suggests that we might go and have another go at this. But if we get another test and hold there, then maybe we're going to see another solid top forming. And then look what happened the last time. We had a decent top up there. We came all the way down. So it's got the potential for a double top, but we need to see if this keeps resisting, and then it needs to pull back and start chugging under some of these levels. Now, the euro dollar has been a bit of a laggard, particularly yesterday. It was a bit slow versus some of the other pairs, which was down to this risk on move. A lot of the euro crosses were heading lower, particularly against commodity currencies, euro CAD, euro Aussie, euro Kiwi, that sort of thing. So it's been a bit caught up, and this move up to 112 looks like a bit of a catch up. And on the back of what cable's done through 134, Aussie dollar tapping 69. But as you can see, as soon as we hit a big level, that's where the trouble starts. Possible there's barriers up here as well. Did we? I can't remember if we actually tapped 112 last time. I'll have to check it out. But that could be in play. I've got no confirmation. So from here, you know what it needs to do. It needs to hold around here, and then we should get another attempt on there. If that holds, then maybe we're going to see a steeper pullback. I am tickling in a buy stop just above it, just based on the fact that this is the second test in a pretty short period of time and a pretty solid return back here after that support at the 110 level. So I've got a little buy stop up above. I'm not keen right now on turning short because I'm still long, and I took a bit off 11.95 first thing this morning. So I've got a buy stop just above in case we do break it. I'll play it as a trade all on its own, with a stop just below or just around this 80s area. I'm probably going to stick it below actually, as a short-term play. And if it does continue, then I'll just fold it into the core position. But if you're short or wanting to go short, this is the level you need to keep an eye on. So another test, it may get the shorts coming in. It may give you a bit more value than just the 80 level. Who knows? I may even try a separate short while keeping my longer-term longs. We shall see. Dollar yen. This one, it keeps bouncing back. I did go a little long yesterday into this level down here, 143, 45, 40, 50, whatever you want to call it. Fortunately, my stop stayed intact overnight and it's bounced back nicely. So we're up against this 42, 20, 30 area, 25, 30 area again. The big one still remains this 40, this 144, 50, 60 area. We can't get through and hold a break through that. So that's really going to be the important level there. And then we run straight into the 144.90, 155 zone, which has seen plenty of action previously as well. So still a bit of work to do, but the fact that the dips are being bought pretty well keeps this momentum going off the bottom. But as I say, it needs to crack through this area to keep going. Or again, we may see the clock running down and people getting bored, waiting for it to break, and then they take a bit more profit and we see a steeper pullback. Cable, that had a mooch up through 134. Couldn't hold on to it. We're back below, just maybe seeing a bit of evidence that we're going to start resisting up there again. So if that happens, then that sets up the potential for a bit of a steeper pullback as well. You know what cable's like. We can, if we don't go up through there, we can be just as quickly back to 133 to figure if it doesn't hold. So that one's potentially in a bit of a coin toss situation as well. Euro sterling staged a bit of a bounce. We got through this low, which goes all the way back to 2023, if I recall, 2022 actually. These lows around the July, August 2022 area. So we did go below there. Couldn't quite get down to the 83 figure, nor this next big line either. But the price action, you know, it came through this level, this 83.40 level, immediately found resistance. Then we found resistance twice, 3 times before we've had this move up. And this again has been a bit of a combination of that euro dollar playing catch up with the others and that cable failure at 134. So this one, I think, is a bit still at the mercy of what's happening, the volatility difference between cable and the euro. 83.60 is another older traffic area. We had a really minor hold in the first move down here. You can just about see it in there before we get in the break. Let's see if it holds up here as well. The bigger level is obviously getting into the 83, 85 area. Which is obviously this zone here, just coming in below that big 84 figure, 84.20 area. So if we get up there and it holds around there, it's going to keep shorts happy. And it keeps the downside momentum going as well. But back above there, it will start to change the picture a little bit too. Interesting development in Aussie dollar, because we did break 69s. Up to 60, let's see, 69.08. So that's significant for 2 reasons. One, we easily broke the figure and made a new high, which takes us above this double top over here, going back to the summer of last year. That's significant because it just shows you what the momentum's like at the moment. Okay, it's very, very bullish. So just taking out that high, 69 level, you know, by 10, 12 pips or so, is just a psychological move as well. It just shows you that we could be on for a bit more. And again, it's maintaining this whole phase, or this second phase of this bigger move here. So we have pulled back, but again, not pulled back too far. 68.70, and against that old fib that you can see there is where we're holding, but now we're finding a bit of resistance up into the top of this zone and that prior high area there. So again, another one that's a bit in, you know, bit sitting on the fence. If it gets below 68.70, then maybe we're going to see a bit more of a pullback as last minute longs, late longs throw in the towel. May get a pullback to 68.50. Back under 68.50, then things may be looking a bit uglier. And then keep an eye on what the commodity space is doing. Otherwise, we've already had that little move. potentially a little bit of a stop run there, and then straight after 69 is still resisting. So the momentum's still very bullish, but the levels are going to speak for themselves from here. You know what they are for now. One area to keep an eye on as well is the goings on in China. I'm keeping half an eye on Chinese stocks at the moment. We had a nice gap up on the open on the back of those rate cuts from yesterday and the one today, and suggestions and everything. Decent gap higher, but as you can see, it hasn't taken long for that to run out of steam. Not quite got back down to yesterday's closing area, but still, that's not something you want to see when you've just thrown the kitchen sink in terms of monetary policy at the economy. Now, we know there's that special program that they're bringing in for hedge funds and the like to access funds to buy stocks. I don't think that's kicked in just yet. So we may have to wait for that to happen before we start seeing any further improvement. But the bigger picture, it still needs a lot of going before we start to get to some more meaningful levels in the stock market, you know, back up at least into the, you know, mid 3000s. That's where China would likely want it, back up towards those sort of levels, and turning around this bearish move that we've seen over the last couple of years. Now, what we've got here is all these measures are all well and good that they're doing, but that's mainly going to help the domestic economy. And as we know, the domestic economy isn't all of the economy. They are a very export-led economy as well, as we know from prior calls of them being the global growth engine. So it all may be good for the domestic side of things, but those measures aren't going to attract international interest, either for further business or investment. And that's something China will be keeping an eye on, because they are very export driven, so they need that business as well to help their economy. If these measures don't spark that or get the domestic side of things improving to an extent it can offset weakness in exports, then I think we're going to see a tone change from China in terms of how it reacts with the West, the US, Europe, and everything else. We may get some easing of tensions on that side. We know they've had 5 or 6 of these joint US business committee meetings over the last few months, so those seem to be stepping up a gear, although there's been no resolution from them. The fact that they're continuing to communicate, as I say, could suggest a change of tone. So if we see things easing in tensions, talking about chips, electric vehicles, all that sort of stuff, trade in general, tariffs, that will be a real big risk on move, and it'll make this, what we're seeing at the moment, look like a piss in the ocean. So this is all longer term stuff, but this is the fundamental stuff I like to keep an eye on, because if you can catch those sort of moves, those are the big ones. Those are your Aussie dollar going back up to 80 and that sort of thing. So we just keep an eye on that, and as always, if you stay here following the Flow Show, we'll keep you up to date on those mechanics as we see them. Right, let's have a look. What are you guys going on about? Why is the Thai baht so strong last few months with low rates? Couldn't tell you why the Thai baht is so strong. Not something I look at every day, if at all. Look at it in terms of relative currencies along those lines, EM markets and that sort of thing. That will give you an idea whether it's just a Thai baht or whether it's just an EM trend, Asia trend, if you like. A lot of these, don't forget, a lot of these react to what the Fed do as well. A lot of these Asian banks, EM banks, have their rates tied in, their rate moves tied in with what the Fed does. So it can be a bit of a knock-on effect there. But no idea, I'm afraid, exactly what's happening in the Thai baht. Lovely country though, like to go back to it at some point. Had a nice trip down there in 2006, I think it was. Anyway, enough of the history. Dimitri, yeah, I'm going to have a look at CAD actually. Let's start with dollar CAD for now. They're pulling back a bit. We're seeing one thing. We're seeing oil stabilize for one thing, so which might have put the brakes on some of these CAD moves, because this risk trade may only run so far before people go that enough's enough. Everyone's got too excited over the back of it. Dollar CAD has broken that prior low around that 134.30s area, and it's just trying to hold resistance against it now. If it does that, then we're probably going to be seeing a move to the 134 figure not long after. So we're just mooching around this level at the moment. What it has done is look like another break below this zone, and this second one coming and making a lower low would suggest that we might be seeing a bit of resistance now coming in either at the bottom of this zone or up towards the top of the zone. So if you're short this one, then that's the area that you want to hold. If we're back above there, then again we're looking like another bit of a fake out. But again, psychologically, just making this newer low keeps the momentum going, and it's been a bit bearish, as you can see, since August. As for the other crosses, well, as I mentioned, if you look at Euro CAD, it's okay. It's not bouncing hugely, but we've now had a couple of goes down here in the short term. Again, it has taken a new low, more so than that one. So again, that just keeps the momentum going. But it is showing signs of just maybe slowing down a bit. And then obviously, if we're not seeing the commodity currencies gaining, we're seeing them pull back like we are in the Aussie, in the Kiwi dollar, and the like, then you're going to see these recovering a bit more. But I don't know if we're going to bounce all the way back up. The levels, just keep an eye on these little bounce highs. Those are going to be your first indication of whether we're going to be changing around this move. And if we go through that low, then we're going to keep going. So today may just be a bit of a pause. And as I said, if you keep an eye on things like oil, US oil, we got up to my zone here, this 72, 73 area, which is a big old long-term traffic zone going back and back and back and back and back. So that's where enough was enough for this risk rally in terms of oil. Probably finding some fundamental sellers up there who are saying, well, the world isn't solved just yet. So that's as far as we're going to take it for now. And we've had a bit of a pullback, and that's coming even amid the storm stuff and the Middle East stuff going on. So again, this is probably putting the brakes on a lot of these commodity currency moves, as we see in copper. Got up to the 50 fib of this move. That's where it ran into trouble, and now we're seeing a bit of a pullback. Again, it's looking similar to the Chinese stock situation. So this risk rally that we've had the last couple of days, it might be coming to an end. It might be pausing. We don't know. That's been the driver in the early part of this week, and thus it'll be a driver moving forward, whether it continues or not. So yeah, keep an eye on your commodity blocks. You need lots of eyes when you're a trader, lots of eyes, just to know what's moving what and what's driving what. We've seen the dollar looking weak in some pairs, Aussie dollar, cable, obviously, because the pound can be a commodity currency when it feels the need to. So that by mechanics has shown dollar weakness. But then yesterday afternoon, we saw some pure dollar weakness, particularly after the conference data. So you've got to know what's driving it. It's not all, yes, dollar's weak, yes, dollar's strong. It can be different strengths and weaknesses. So knowing when maybe a move is a commodity related move or a risk on move, or whether it's a dollar move, you need to identify those, because that's what helps you make your trading decisions in any of these dollar pairs or anything else. Knowing what's driving what, and it's changing very quickly. So that's why I use a lot of 15-minute charts, because they're good for spotting those changes when it's commodity move or dollar move or whatever type of move. So get your charts geared up. This is one reason why the dollar is going to be on the weak foot in phases. That's yields coming down. The 2-year yields again, just making another low yesterday. So it's keeping the momentum going. When we had this bounce and this move higher, I said they're likely to remain under pressure in these yields because this is where we're playing how far rates are coming down. And that, if you compare to 10-year yields, which are still climbing off of their lows, although we did have a pullback after that data yesterday, a bit of a reminder that not everything's going in the right direction in the US, but this is still a curve move. So we're still seeing the short end coming down on rate expectations, but the market's sensing that further down the line, the US economy isn't going to collapse. And if it improves, then obviously rates are going to be coming higher because we're going to be getting inflation and whatever. So the longer term picture is suggesting that rates, all being well, going to come down to whatever neutral level it is. Let's call it 3%. The economy improves, and then we start maybe needing to adjust policy just to combat if things start heating up, or they get cut more if they start cooling down. So it's going to be a more normalization management of rates later on. But the 10 years and further out are saying that rates will likely be, or should likely be, higher in that duration further down the line. George, yeah, I'm going to start selling spare eyes, I think, and because you need a lot of them at the moment. Right, you guys and girls, got anything you want to have a look at? Let me know in the comments. K-Man's still off, so I'm going to see if I can drag up a couple of guests in the rest of the week. I think we're going to have Gregor coming on at some point, and I might have a couple of other surprises if I can pull them out the woodwork. Depends how much beer I've got to tempt them with. No, you want to look at Bitcoin? Oh my days! Oh my days! Bitcoin. Look where it is, all the way down here, right under corn. That's the importance I assign to that, and I never look at corn. Right, let's have a look at the old Bitcoin then. What's going on in Bitcoin? Okay, still walking this loose downtrend. Forget those lines; they're just there for visuals more than we're in a channel. Though you could say we're in a channel. Trade between the lines, mate, is my advice at the moment. People might be looking at this as a big old bull flag developing, which will make a break, a moon shoot to, I don't know, 90,000 or something. What are you doing with it, Nuno? Give us a shout about what you're doing with it. Yeah, that's 65 level, Gav. Oh, it's coming a bit just along the top here. That's your level as well. It's looking a bit like the Aussie dollar as well, with a little double top earlier, and then we're mooching again. But that's your level. We're in an uptrend off this oldish support area down here, 52s, 53s. So you get a break here, we might get a test top side of that trend line up there, 68. So that's one way to look at it. 100k all the way, Brad. Yep, I'm still bid at 31. Yeah, 31 bucks I'm bid at, which is still a buck ahead of K-Man's bid, because that's the vulture I am. Right, a couple more to look at quickly. Dollar yen seems to accumulate to extend. Yeah, it's possible. It's funny. Bitcoin, it can become a bit of a risk play. It can become a bit of a fundamental play. It's always switching between one theme or another. It never seems to really settle on something new now. So, yeah, it could extend. It's looking like it might extend. What you're going to do, though, if it doesn't extend, that's the trading aspect to it. I already looked at dollar yen, didn't I? Silly. See, I'm even losing what I'm looking at. What was the other one I wanted to look at? Yeah, let's look at the old dollar stocky, because the market really took the dovish turn, or the heavier dovish turn at the Riksbank in its stride. We saw Swedish krona weakening a bit, but even with throwing around 50s now, it hasn't really done much. This is a pattern that one of our guys in our chat room looked at, which was the wedge that we've got going on here, and we're just breaking. We have broken below that, and for now we're holding below that. So that could be significant for the next part of this move. If we don't get back above that in this sort of 10, 14, 15 area, then we could be heading for more downside. Next level for me below is that spike at 10.05. And while we're on the Scandis quickly, it's another one I'm in. I was umming and ahhing whether to fold this yesterday. I'm long off this 10.45, but overnight it got down to my next level, touched it right on the nose before bouncing. So that's a bit more positive for my trade, but I need it above this 10.45 area. I'm still in two minds whether to keep or fold it, and I don't know. This is one of those times where I almost know what I should do, but I'm not going to do it. So it may be I just have to take the punishment on this one, just because I'm being a bit stubborn. I could get out up here and make a little bit on what I cut up towards 10.55, or I could just keep the trade and see what it wants to do and end up losing anyway. So yeah, I don't know why. Just this one, I'm being a bit stubborn on. As I say, I know I should have probably cut it last night. Didn't. I don't want to take a loss on it. So yeah, I'm going to be stubborn and stick to the trade. And my stops at 10.38, and we'll see what happens. And it's a bit the same. Yeah, I'm long. If you're talking about this one, Nuno, I'm long 10.45. Already did a slice, as mentioned, up at these highs, 10.55s. But otherwise, technically, it's looking pretty good, pretty clean. And I always like it when you get clean moves, like tapping that 10.39 on the nose, tapping this 10.55, 56 on the nose. You know, the levels are pretty clean. That always helps you when you're trading, rather than getting a little, halfway up and stuck in the middle and those types of things. Can make trading a bit easier. So yeah, I'm on this one. We'll see what happens. What was that bounce level looking left? Which one? Are you talking dollar Swedish or this one, Angela? If you're talking dollar Swedish, let's go into that one. So that was, there's a little bit of traffic in there. No, which one? Dollar knock. Knock. Gotcha. Yeah, so this was the level, the 10.39 I've marked down, which again is another one of those. Oh, let's keep it in. Another one of those ones that just has a bit of prior history going back all the way through. That's why I keep charts like this, because I don't trade this a lot. I just stick to the bigger levels I feel are going to be more significant, rather than messing around in the middle trend lines. And there's not even really any fib action going on here for me. So yeah, just simple lines, don't need a lot, and they're enough for me to trade anyway. No problem, Angela. Yeah, that 10.40, a monthly level, going back to April, Gav. Okay, 10.40. Is that? Well, close enough. 10.39s, 40s, whatever you want to call it. Yeah, close enough for government work, as they say. Yeah, quick look at the Swissy. Some speculation, and I'm speculating it as well. We're seeing a quite significant bounce in dollar Swiss at the moment. Swiss in general, pairs in general, Euro Swiss up as well. This has got the market chattering that maybe the S&B has started to, let's just say, try and smooth things, or start to smooth things, which could insinuate they're only going to go a 25 pip cut tomorrow, because that would, even though that's what's being expected, the market may still be a bit disappointed if they only go a 25 pip cut. So as I say, speculations coming in that we're seeing a bit of S&B action here, just to smooth a 25 pip cut if it becomes a disappointment to the market. They'd rather take it up and then get the disappointment back down there than be sitting down there and get a disappointment below there and even lower. So that's a speculation anyway. I don't know what they're going to do tomorrow, Nuno. It's a difficult. S&P is a difficult one. Inflation never went that high. Rates never went that high. So obviously they're going to be worried if inflation comes back down significantly. But does it warrant a 50 pip cut over 25? I don't know. I really don't know. It's such a narrow situation for the S&P compared to everyone else. You know, the Bank of England, they've got rates at, you know, CPI still up at over 2%, core at 3.2%. Or 3.6%. The Fed have got core at 3.2%, rates up at 5%. So it's a much broader situation for those than it is for the S&P. But if they're worried, really worried, then they'll go a 50. But as I say, the market's expecting a 25, but that's economist thinking. The wider market may be a bit disappointed by that. So I think it's a bit of a coin toss. If it's a 25 pip, CHF pairs will go down, not CHF, not the Swissy. Okay, so the Swissy will likely strengthen on a 25, and the S&P don't want it strengthening too much because it's far too strong already. So yeah, this could be one bank that actually gets put under pressure from lower inflation, like inflation going back down to, you know, 0 or something like that, and then they'll be looking at, well, the market will be looking at negative rates and all that palaver yet again. So this could be a good litmus test for what some of the other central banks may face in the future. Right, on that note, I'm going to call it a day because I've been waffling on for 45 minutes, just listening to my own voice. Thank you, as always, for your views. Thanks for coming to the Flow Show, as always. Don't forget to catch us on Face later, and again, take advantage of our wonderful sale that we've got going on. Take it easy, everybody. Trade safe, trade well, and we'll see you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.